Okay, good morning and happy Tuesday, everyone, to our Tuesday morning market outlook session. And today we're going to be taking a look at a bit of a macro view here on the underlying markets because we have reached some pretty critical stages as respect to the overall market. We've had a pretty spectacular rally, so we have quite a bit of different charts that we want to take a look at. But again, today more of a macro view because we did have a spectacular jobs number on Friday that drove a lot of the outperformance we've seen over the last couple of trading sessions. Yesterday, we just had news that it's official that the United States has entered a depression starting back in February. So a lot to unpack here today. Markets haven't moved substantially on some of these the news, but we do want to talk about some of the levels that we currently are seeing in the markets. Now, before I get started, everything that I'm going to talk about here is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So again, it's official. We are now officially in a depression or recession rather, in terms of the markets, in terms of the U.S. economy, starting as of February. This was announced yesterday based on data that we now have with respect to GDP. And I will say that this is what drives some new sentiment at the moment, but the markets, if you look at the markets, it seems to have pretty much shrugged this off at the moment. You wouldn't be able to know that we are currently in a recession based on looking at the markets. Leadership has broadened out substantially. This is some of the things that we're going to look at here today, and this is really part of why we continue to be bullish here in the market, despite the fact that we are clearly in a depression and things don't look particularly well from an economics perspective. Things certainly are very overbought on certain indicators. Depending on where you look, most of the markets that we'll look at today, regardless of whether we're looking at sectors or if we're looking at specific markets, we are starting to see overbought conditions. But I do want to make sure that everyone understands that when you see an overbought condition, what that actually means. I tend to find that a lot of people use overbought conditions and go out and they short markets and things like that. And I want to be clear as far as what overbought actually means, what the statistics show us, and hopefully that helps you guide as far as how do you trade the markets that are overbought. I want to take a look at some of the income and job numbers as well, because income is really what's driven a lot of the strength that we've seen over the last couple of weeks, if you will, starting in April. The job numbers obviously was what drove the big move on Friday and the subsequent move on Monday and going into today. So we want to discuss some of those job numbers, what they actually meant, what maybe misclassifications we might see from those job numbers and what they mean. And then what we'll do is we'll spend most of our time looking at all of the sectors. I want to review every single sector, show you where every single sector stands, which ones are overbought, which ones are not, so that you have a better understanding as you pick your securities going forward, which sectors you might want to focus on. And at the end, if we have a few minutes, I'll try to answer some questions that you guys might have with respect to the markets. And Stephen is right. I meant recession, not depression. I apologize. So today, what we're trying to answer is the primary question that I've been getting over the past couple of days, and is really just, are the markets due for a correction? I know there's been some sentiment of this for the past few weeks, not just the past few days, but I will say that this has increased a bit over the last few days as markets reach kind of almost a bit of a euphoric stage, if you will, continuing to climb at some pretty phenomenal rates based on the good news that we have seen from that jobs report. So today we want to take a look at the overall markets and understand how to go about doing that. And for those of you that don't know who I am, my name is Tony Zhang. I'm the chief strategist here at Options Play, and you can find me on CNBC on Friday evenings on Options Action at 5:30 p.m. if you're looking for trade ideas and if you're looking for ways to play the current market. So let's first start off by talking about the S&P 500. We've been discussing this for quite a few months now. We've had a pretty spectacular rebound. The most recent level that we've been talking about for the past few weeks is about 300, 302 on the S&P. And I've been saying that once we break above 302, we're going to get a move higher. I will say that when I initially made that, when I said that, I didn't expect the move to be this quick, this fast. And it certainly has felt a little bit too fast, if you will. And I think a lot of people are asking, are we due for a correction lower? So first off, I want to point out is that for quite some time, during this initial rally, we were saying that how as markets pushed higher, momentum did not push higher. But over the past few weeks, as the markets continue to move higher, momentum has continued to follow that higher and has now reached what we would consider overbought conditions. Now, what I want to, again, clarify today is what overbought actually means, because a lot of users or investors may hear the word overbought, and the first thing they think about is shorting. They think about it's time to short the markets. And I just want to be clear that that's not, from our research, necessarily the best way to trade an overbought market, because markets can, number one, stay overbought for an extended amount of time. And I think a good example of this in recent past was just in November through February, where for almost the entire time, markets were overbought, but will continue to move higher. And one of the other things that I want to specify is that when markets turn back from being overbought, like we saw here back in right before December 31st, once again back here in late January, early February, mid-February, during all of these times, any pullbacks that we have seen in the markets were very, very small, just less than a couple of percentage points, 2 to 3 percentage points. So outright shorting these markets just because it's overbought many times is not a strategy that works very well unless you're talking about very, very short term, and we're talking about over just a couple of trading days. As you have seen here over the past few months, we have seen some pullbacks, but usually they last no more than 2 or 3 trading sessions, and the markets resume higher. So when we say that markets are overbought and we think that there's a possibility or a higher possibility of a pullback, just keep in mind that that pullback may be very shallow and may last only 2 to 3 trading sessions. So usually when we talk about markets are overbought, we usually think of these as better opportunities to take profits on your long positions rather than necessarily going short. Again, unless you are talking about very, very, very short-term shorts that you know you're going to be out of within a day or two. But even those opportunities are very short-lived, and you have to be very careful with taking profits very, very quickly, because they don't tend to last very long, especially in these types of what I would consider strong bullish markets that we're currently seeing. If you look at the daily chart, the weekly chart, they are extremely strong. But we are starting to see some signs of negative divergence across the board. So if you look at the S&P 500, you certainly have some negative divergence on that momentum. And again, one of the things about divergence is another one of those terms that many technical traders will say, oh, I see negative divergence, it's time to short. Also, divergence itself does not tell you anything with respect to the magnitude as far as how much that market can pull back from. So negative divergence can resolve itself with just a small pullback, let's say back to 310, and start moving higher. Not a big opportunity to short. So again, these conditions that we usually associate with time to short or time for a correction, many times from our research shows that that's not always the case, especially in these strong bullish markets. So I just want to be very clear as to the fact that even though we are clearly in an overbought condition, what the right approach to trading the markets are. Okay, so again, taking profits, generally speaking, on long positions is a good time. It's, when markets reach overbought, it's usually a good time to start thinking about taking at least partial profits on some of your long positions. So looking at technology, the NASDAQ 100 index broke out above its all-time high here, QQQ. This is the NASDAQ 100 index. Now, again, we're seeing negative divergence on these moves higher. As you can see, both on the weekly and the daily chart, we see negative divergence. So this is also telling us that markets are near a type of exhaustion. We certainly have a higher probability of a pullback. Now, that's not to say that the markets can't pull back substantially like we saw back here in February. It just means that statistically, that doesn't happen very often, these types of pullback. What's far more likely is that you get a small pullback, maybe back to the 20-day moving average, and then you start to resume that market higher, unless things drastically change with respect to where the economics or the fundamentals of the markets completely change. And that's very possible too. That's not to say that new information can't come out. We can't have a second wave of COVID and all of a sudden we have different markets shut down again. That could cause a severe sell-off. But again, that's new information that we currently don't have right now, and that's just completely speculating as to what could happen in the future. Given the current information that we have, overbought does not necessarily mean it's a good time to go out and short the markets. One of the things I will point out that has been quite phenomenal to watch is the equal weight index of the S&P 500. Now, initially, the rally off of the lows back here in mid-March was predominantly led by what we consider a few mega cap names, very large cap names that were leading the markets higher. The broader market was not really moving significantly higher. This was most extreme in the consumer discretionary space, where the difference between the equal weight and the market cap index or market cap weight was extremely obvious, if you will. But the overall equal weight S&P 500 index has caught up quite a bit over the last few trading sessions, showing us that this broad market, that this rally we're seeing is not just concentrated in a few different names, which is usually the hallmark or the telltale signs that markets are near a top. The fact that you have the whole broader market rallying along with the market cap weight index is usually telling us that the market, there's strength behind this rally, that this is not just a house of cards that's about to collapse. You know, when we see this type of negative divergence and we see that the market breadth is relatively low, those are some concerns for potentially shorting the markets. But again, the broad market rally that we're seeing right now is supportive of the current rally that we see. The Russell, the small cap index, same thing, same type of price action, extreme momentum move to the upside. We still see the same momentum indicators starting to approach overbought. We don't see the same negative divergence here in the small caps. So small caps perhaps looking a little stronger here, but also, you know, in my opinion, subject to potentially a small pullback here, maybe down to the 145 level, which was our initial target on IWM when it first broke out above 135. We tagged that 145, bounced off it, moved higher. I think there's a high probability that IWM moves back to around that 145 level before it starts to move higher. But small caps, technology, broad market, everyone joining in this rally, that is, generally speaking, again, a good thing to see in the markets. So when we see overbought conditions in these markets, you know, this is really where we're not outright going out there trying to short the markets, because we do have broad support here for the rally. VIX does start to take a little higher here over the past couple of trading sessions, showing us that complacency is not necessarily settling in, that there's still some fear that markets are going to correct. And I think, again, that speaks to the first slide that I had up there, which is, you know, investors asking, are we due for a correction? Certainly there seems to be some positioning for buying some put options to potentially hedge for a move to the downside. But again, that's very minor. We're still well below 30 in terms of the VIX. Chances are, if we start getting up to that 30 level, we'll start to sell off here again, given the current information that we have. Things could change very rapidly because we are in I would say, a situation where things could deteriorate significantly against us too. Crude, I want to talk about crude because crude managed to touch that $40 level here, and we did get news that crude, so, you know, we declined significantly below that $40 level. We're now right back at that resistance level. So this is a key level to pay attention to as to whether or not crude can break back above it. Now, we did get some news, I think it was yesterday, from the Wall Street Journal, stating that some of the rigs here in the US have started to pump oil again, which means that we're going to start adding some supply to the market. That usually puts some downward pressure here on the crude markets. We have had a very spectacular rally, the largest rally, I believe, in oil for a very long time. So $40 is a key level for us to keep an eye on, and I think this is relevant. This is potentially relevant when we look at the energy sector. Crude also reaching overbought. We don't have the same negative divergence we've seen in the other markets, but you know, with such a spectacular rally, I think that it is reasonable to see some type of consolidation or pullback even to that $32, $33 level just in the short run from a positioning perspective. So that's the broad market that we want to take a look at in terms of understanding where we currently stand, how we're looking at the market from a macro perspective. So what we want to take a look at is some of the economic numbers. Now, I was putting this together, and just the sheer number of charts that I could possibly show you right now in terms of all the different things that we're looking at is mind-boggling. But I did want to look at two charts that I think is important, perhaps from a timing perspective and also from just an awareness perspective with respect to the economic numbers that we saw on Friday that drove so much of the outperformance we've seen over the last two trading sessions. So this is a chart that I actually showed last week, but we didn't have the forecast out there. And what we were showing was really just the impact of the stimulus, which actually, as you can see here in the blue bar, versus the loss in income that you see in the red bar. And as you can see here, back in April, when the stimulus check hit, and you compound that with the fact that in April, a lot of people got their tax refunds. When you look at the net income in April, there was actually a net positive despite the loss in income due to COVID because of the stimulus, because of tax refunds. And this shows us that the PPP, that the stimulus that the government handed out actually worked in terms of offsetting income loss in the month of April. In the month of May, what we expect to see, and this is forecast because we don't have the data yet to complete this, but as you can see in May, the loss of income actually got worse, but again, the PPP and the stimulus that the government provided mostly, for the most part, offset the loss in income. So until at the end of May, we're looking at a net positive for income in people's pockets as a result of the stimulus and tax refunds. In June, you start to see this normalize a little bit more, where the loss of income is still expected to be fairly significant, and the stimulus obviously getting smaller. And then by the time you get to July, this is really where, at this point, the stimulus is going to run out, the additional unemployment is going to run out, and starting in August is really where you're going to have the biggest impact. Now, this is provided that the government does not provide any more stimulus, which is not necessarily at this point. We do believe that the government will probably provide some additional forms of stimulus. So this chart again is forecasted. As you can see, it's not until July where the net income is going to be below the stimulus, or the income loss is going to be below the stimulus provided by the government. So, as people think about how do we time this market, we think about when things may start to turn around in terms of consumer spending. This is a chart that I think gives us a lot of visibility into how come there's been so much strength over the past couple of months with respect to some of the consumer stocks, right? I think many people are almost shocked that consumer discretionary stocks have been doing so well, but I think this speaks to as to why that was the case. And then as far as the jobs report that came out substantially better than expected, most of the forecasts were looking at 17 to 19% unemployment. It came out to be 13.5 or 13.3, and we added about 2.5 million jobs when most of the forecasts were expecting about 2 to 3 to 7 million in terms of job losses. And it really comes down to misclassification of the jobs report. And this is something that we started seeing back in March, was that, some people were being misclassified as employed but not at work, when they really should have been unemployed or temporarily laid off. So there's a concern right now as far as the classification of how people are being classified in terms of the job report. So, and I think the market, generally speaking, knows this, that there was some misclassification. And because the number was a phenomenal number, the markets did jump, but it didn't jump a huge amount. It jumped 2-3%, which certainly is substantial, but not, in my opinion, not in line with the jobs report that we actually saw. So those are just some of the things that I wanted to make sure everyone understood as they think about the markets and they think about timing the markets, especially when you're thinking about corrections. Now, the one thing that we did start to touch upon last week, and something that we haven't really talked about very much, because for the most part, the market has pretty much discounted this type of number and hasn't really looked at it very much. But one of the things is that over the past few weeks, the number of cases in the US in terms of COVID-19 has actually started to see a small uptick. Now, historically, we have seen periods of upticks, if you will, small periods of uptick, but this late in the game to have an uptick this long is starting to be concerning, especially when it coincides with economies opening back up. And the question is whether this will continue to start trending lower, or this is going to start having maybe more of a plateau or maybe even an uptick. And I think markets may be sensitive to this number, so it's important for us to keep an eye out on this. Now, I don't necessarily know that this is going to, even if you get a continued uptick in this, that the markets will sell off. I'm not necessarily saying that that's going to happen, but I do think that if we still continue to see this going on for substantially longer than we expect, what that does change is the dynamic as far as how we go about approaching markets going forward. All the stocks that have performed well during lockdowns and social distancing, working from home, that theme may extend substantially longer than we expected based on this type of data. So, and stocks that we were thinking were rallying as a result of reopening, such as some of the travel stocks, casino stocks, they may not do as well, or they may be a little optimistic based on how long this continues. So that's how I think you should look at these types of trends going forward. So let's take a look at the sectors. So materials clearly reaching a bit of an overbought condition, similar to most markets. It has reached a fairly extended move to the upside. As you can see, you have two gaps to the upside. So I do think that you do have a higher probability of move to at least correct and consolidate for a little, maybe at least fill that first gap here. You have some negative divergence here on the markets, but for the most part, it is something that I think may be able to resolve itself relatively quickly. But as you can see, momentum is showing some negative divergence here on materials. So if materials, certainly one of the sectors that I would be looking at taking some profits if you have long positions in. Industrials, very similar chart. You had this huge acceleration to the upside over the past few trading periods. Momentum has reached overbought. You have some negative divergence as well on momentum. So very similar chart here between industrials and materials. Communications, this is actually one of the charts that is, in my opinion, a little bit more orderly. Pretty much a straight line up, hasn't gone that parabolic route, if you will. And if you look at that momentum, it is a pretty steady climb, if you will. It certainly has reached that overbought condition. You also have a bit of negative divergence here as it starts to reach that all-time high. I think communications here it's very clear that communications is likely going to tag that all-time high, maybe contend with it very shortly, and then start to move higher above that. But communications, one of the strongest sectors right now in the overall market. Real estate has really taken off quite a bit over the past few weeks as well, just inching into that overbought territory right now. But as you can see, it only really started to take off over the past couple of weeks. Also some negative divergence here, but actually no negative divergence here on real estate. So real estate breaking out above that $36 level may be one of the sectors that maybe has a little bit more room to grow to the upside, and certainly hasn't quite reached overbought, and you don't see that negative divergence. So real estate, one of the stronger sectors, but don't have the same signs of exhaustion as some of the other sectors. Financials really came to life over the past couple of weeks. This was one of the sectors that I think really broke out to the upside as a result of yield expectations starting to lift off. As we saw 10-year yields took off, is really when the financials started to break out and really start to move to the higher levels. But financials also reaching overbought here. We have some signs of negative divergence here as you make momentum makes a higher high, but price is not capable of making that higher high. From my perspective, that does increase the probability of a short-term pullback here in financials before it can continue moving higher. This has crossed above its 200-week moving average, which is a significant, I would say, milestone for financials, since financials was one of the weakest sectors, with the exception of energy, until the last few weeks or so. So financials, definitely one that I'm keeping my eye out, because I do think financials, once it resolves some of this overbought and the negative divergence, it has the opportunity of moving higher here in the markets. Consumer discretionary, I think consumer discretionary is the only sector at the moment that currently has reclaimed its all-time high, which is pretty spectacular if you think about it, considering that the biggest sector that has driven the economy is consumers and has the largest impact as a result of COVID. The fact that it has now broken above that all-time high puts it in a very different spot, because it actually doesn't have that negative divergence because it was able to make a higher high in terms of price. But as you can see, it is certainly overbought at the moment, which means that you have a possibility of a short-term pullback. But that pullback, again, from my perspective, is unlikely going to be fairly steep. It's likely going to be a fairly shallow, could just last a couple of trading sessions and then start bouncing higher and start making all-time highs. So consumer discretionary, it is difficult to continue to pull the trigger many times on these names like this, but at the moment the markets are very clear in terms of their signal that things are strong, that markets are responding positive to all this news, and you don't want to fight the markets, and you certainly don't want to fight the Fed. Consumer staples, this is an interesting one because it just is breaking out above to the upside. So this is one of the sectors that is playing, I think, catch up. It is not overbought yet, so it has some room to the upside. It just broke out above that $61 or $60.50 level and has quite a bit of room to grow to the upside to that $62, $63 level. This is one of the sectors that I particularly like. Strong dividend yield, fairly stable dividend yield, and is certainly playing catch up right now in this particular market. And as some of the other really high flying sectors start to rotate a little, off a little, you see some profit taking in those sectors, you might see some rotation into the sectors that I have here, which is staples and utilities. Utilities, very similar chart here. You can actually go back to roughly $61 level, which is a major support level, major resistance level, started to break out higher. Momentum is not reached overbought yet. You don't really see a lot of negative divergence here either. So I think you have the possibility of utilities pushing higher here as a result, again, of sector rotation. As some of the other sectors start to see some profit taking, you might see some of that flow coming into sectors like staples, utilities, and even healthcare. Healthcare, which initially was the strongest sector off of that rally, has spent the last month just really consolidating for a long time and is just starting to break out higher and is now contending with that all-time high. If healthcare can break above that, we certainly think that this can continue to run higher. Healthcare also, as you can see, momentum is moving sideways, is not overbought yet. And we do have small amounts of negative divergence, but not a whole lot, so not really concerning at the moment just yet. But again, we might see a small consolidation here before you get a breakout higher here in healthcare. Technology looks very similar to that communications chart. A very, I would say, let's just say a stable move to the upside, very steady move to the upside. As you can see, not a lot of consolidation and parabolic moves, just kind of a very steady climb. And as you can see throughout the steady climb, there were multiple times where it pulled back a couple of percentage points, 2-3 percentage points, but it only lasted a couple of days. And I think you have the opportunity of potentially seeing that. Again, I don't think it's a great opportunity to short. I think you're better off waiting for that pullback and looking to buy those dips. That, in my opinion, is a much better strategy to take when markets are overbought in these types of conditions. And always, when you're taking these types of strategies, the best thing, in my opinion, is to always utilize options, because options allow you to take on this type of risk without taking on this type of exposure without taking on an excessive amount of risk. Energy breaking out higher, but reaching severely overbought conditions. You certainly have negative divergence all over the board here. So energy is certainly one of the stocks that we talked about before, where oil has certainly hit that $40 cap. We think that we might get a short-term pullback from that, so that's likely to see also a bit of a short-term pullback here in energy. So those are the sectors that we're currently looking at. Like I said, the broad market rally seems to be very supportive currently of this move. We haven't, even though we've reached these kind of overbought and we're starting to see negative divergences, I don't think it's necessarily time to go out there and short the markets. It's better off, in my opinion, to look at taking profits on some of those really overbought sectors and then perhaps rotating into some of the sectors that are a little weaker, that are starting to break out, like staples, utilities, and healthcare. So with that covers what I wanted to go over with you here today. Thank you so much for participating. I really hope that this is helpful in helping you set up your trading day. And I hope that you guys have a great trading day. And I'll see you guys here on next week. Have a great day.